Welcome to TheoTrade. This is Don Kaufman. July 15th, 2022, just about an hour after the cash close here on this Friday afternoon. The markets seeing a nice bounce towards the end of the week, but the economic issues, they just continue to mount. I mean, it just keeps coming in this marketplace. And I'll explain what that means and a whole lot more here on this weekend's update. All right, let's start with just a brief kind of week in review. In fact, I'm starting here with a 30-day, again, a 30-day 1 hour. And the reason that I'm using this 30-day 1 hour is just to emphasize the point, yes, there is huge intraday volatility. I mean, at one point yesterday, the S&Ps are down. And again, I'm speaking of Thursday. At one point on Thursday, the S&Ps are down 70 handles. The next thing, all right, they're even. And then today they're up some 70 handles. Like, I can't even make up my mind. But the reality is, take a look at the range that we are in. With a few, lows being put in, though, for the most part, we're trading in a range right now from, let's just roughly put it like 3750 on up to the upper edge of that range. Actually happens to be a gravity point of 3931. So effectively, you've got, this just wild, almost 200 point S&P range where it is just that. It's Mr. Toad's wild ride inside of there. But this kind of trade is phenomenal for certain strategies. But when it comes to trying to allocate a little bit more heavily, this kind of range actually makes me nervous. And that's something I haven't mentioned in a really, really long time. And I want to kick it off right here on this weekend's update, because one of the most important things that I can discern to you, it's not about like, oh, the market went up, the market went down, we got a MACD, we got a Fibonacci. What you've got inside of the S&Ps right now is ultimately allocation that has been mounting inside of this 200 point plus range. And what occurs at that particular point in time is you're just building open interest and building open interest. And I am referencing the options marketplace. And the reason I'm mentioning the options marketplace, like how many billions of dollars are going to be sitting on any given one of these strikes inside of the SPX? Do you want to look at the 3,800 strike, the 3,850, the 3,900? The longer you sit within a given range, the more dangerous it actually becomes. And I don't think enough people are actually paying attention to, they have tendency to like look over at the spiders. And when you look at the spiders on a daily, like, okay, I kind of get what he's saying in here. But yeah, we're now just over a month inside a relatively tight volatility box. And it's tight in terms of the fact that, well, we're still sitting at a 24, 25 VIX. Speaking of VIX, this is actually one of the lower VIXs we've seen since we've been inside of this range. So the markets, unfortunately, are becoming complacent, and the open interest just continues to, just adds up and adds up. In fact, it's worth taking a quick glance over at the SPX, the mother of all products. And like, I think this is a wonderful example because the SPX obviously traded some size today. It's an expiration. Every Friday is an expiration. But there was also a primary expiration today, a monthly. Don't worry, the SPX only traded 2 million contracts. That is a sick number, 2 million contracts. And most people are like, oh, I don't even know the SPX. It's 2 million contracts of almost a $4,000 product. But wait, there's more. If you take a look at the spiders, spiders are good for 7 million. So you just add up the SPX and the spiders. And I do this all the time because, again, a lot of people don't get it. The market today probably only traded a total. And again, I want to add up everything, every option contract that traded today. The whole market probably did, about 40 million. So the entire market did about 40 million contracts. Just the spiders and the SPX are almost good for a quarter of that. They're almost good for a quarter of that. And you wonder why there's cause for concern. There's huge cause for concern. So what is that cause for concern? The longer we're within that range, you start to hit a little bit of a crescendo. And the amount of risk coming out of this range, doesn't matter whether it's higher or lower, but the amount of risk coming out of this particular range becomes downright violent when we do break the range, because what we're doing is we're pushing off where the heaviest amounts of open interest and the heaviest amounts of gamma. So if you guys are familiar with the term, gamma squeezes and so forth, there's evidence that that actually is transpiring literally today. In fact, almost a nothing news announcement came out today, and the markets exploded higher, probably because it was gamma around an expiration. It was an AM settlement. People, that's before the market even opened. We exploded higher, and then effectively after the market opened, we did a whole lot of nothing the entire trading session. Again, but we're accumulating this just immense amount of open interest in a very, very tight range in a highly volatile situation. Like, again, let me further that with the fact that once again, we still have a relatively low skew, right? So the lower skew indicates coming out, and selling off could actually be really hideous. The VVIX, okay, has pretty much, that's the volatility index, hasn't been this low in, well, considerable period of time. You got to start opening up like 3 and 5 year charts to see VVIX this low. Again, the one aspect that I'll reiterate, and I like to kick off with this, risk continues to mount. Economic issues are coming. And the reason I actually entitled this weekend update, markets bounce while economic issues continue to mount. The problem with the economic issues right now is that they're sparking this tremendous amount of volatility on what I would term nothing news. By the way, you can actually see on an intraday basis, again, almost a nothing announcement over here, like Michigan sentiment numbers, University of Michigan sentiment numbers. Look at the move. I mean, you can't make that stuff up. This is a 1 minute candle. We moved from 28 ultimately up to 54. How does that grab you? Now, granted, there was some Fed speak at the exact same time that University of Michigan, sentiment number came out, but the sentiment number, like, really, it was a big nothing. Maybe they were listening to the Fed. Nevertheless, that is one of the issues because, as I'm saying, we're data dependent right now. Everybody knows that the FOMC announcement is coming on July 27th. The Fed is about to go into their quiet period. So in terms of Fed rhetoric, they got to get it out. They got to get it done. They're going to go into a quiet period. While the Fed is in the quiet period, every ounce of data that comes out this next week, all right, is the possibility of absolutely rocking markets. Like, housing starts have never done anything to the S&Ps. Look out, all right? Like, really, look out. You're looking out at some of the numbers here, like, there's nothing that big. ECB announcement, that's big next week. But the point that I'm making is we are going to be in this proverbial constant, alert of getting tape bombed. And tape bombed, if you're unfamiliar with that, I was talking about it last weekend. This is what I mean by getting tape bombed. A little bit of nothing data hits the tape. We make 20 and 30 point moves inside of the S&Ps inside of 1 minute. And that's, it's inescapable. I mean, this is stuff that can just rip you apart. Anyway, so some retail sales numbers came out this morning and sparked this. And the irony of retail sales, and it is rather ironic, and that's why I wanted to say that we're data dependent and sketchy. Here's the sketchy part. Retail sales came out better than expected, which, from my point of view, it's good. Great. The consumer is still spending. We're not necessarily in a recession, but it's also providing fuel for the Fed to turn around and go, yeah, now we can really stuff them with some higher rates, because clearly we're not cooling off the consumer. But wait, it gets better. The best part of this is consumer debt, that's your credit card debt, has exploded in the last couple of months. So yeah, right now that data looks good on the surface, but it's sketchy down the road. And frankly, I'm rather surprised that markets didn't fade off of this. And here's probably the most ironic thing, okay? Today, that announcement comes out markets open here at 9:30 Eastern time, and we did start to fade right up until some Fed speak, and boom, that was that University of Michigan sentiment number that that took us to the upside. So I warn you, tape bombs aplenty. Everything is going to be data dependent for the Fed, and the Fed has got to be quiet. Now, let's move on. Earnings, they've kicked off. So what can we say about earnings? First, the only earnings we've really heard right now are the financials. JP Morgan, ooh, not so good, right? And I want to make this point because it's a really prevalent one. JP Morgan came out and they missed. Morgan Stanley came out, okay? And again, I'll bring up JP Morgan, and JP Morgan yesterday, they missed. Stock sold off quite significantly. JP Morgan, all right, also had some really not so positive comments for the future. Nevertheless, Morgan Stanley comes out. They're a little bit less bearish in the commentary. Meanwhile, today you heard from Citi. Citi comes out, and they actually beat, okay? Stock flew. And the most interesting part of the stock flying to the upside, do realize it took Wells Fargo with it. Wells Fargo missed, okay? One thing you can learn from this, earnings are mixed, but do the numbers actually matter, okay? My answer to you is absolutely unequivocally not. No one even cares at this point. So when you're having a down day, you know, based on JP Morgan gets slammed to the downside, took all over the financials with it. Even Bank of America yesterday, which is Thursday, took a significant hit. Look at the bounce today. Predicated on what? Well, the entire market bounced. Exactly the point that I'm trying to make. The correlation of markets right now, okay, is almost unprecedented. If you take a look, the whole market is moving as one unit. I mean, basically, whatever the S&P 500 is doing, it's going to move the entire basket. Granted, I know I have the S&P 100 up here. The entire basket, though, is moving literally as one unit. And one of the most interesting things to see is, you know, if you had the Wells Fargo numbers in your hand yesterday, okay, would you have actually made a bullish trade? Of course not. They missed, right? You can pull up all the data. And the reason that I think this is so incredibly pivotal is that now you have tech up on deck. And when I say tech is on deck, all right, let's quantify that. First of all, like Apple, you got to wait a little while for Apple. Apple's coming out, ironically, right after the Fed. Not right after the Fed, like a day after the Fed. If you want to wait for like Microsoft, ooh, exciting stuff. Microsoft's coming out actually the day before the Fed. But when we start to talk about tech, we're going to hear from the likes of like Netflix, the IBMs and so forth. But the monsters of tech, we have to wait the following week. But again, with tech on deck in a market that's heavily correlated, it's just dangerous. Again, it comes back to this data dependency where it's like one announcement can shift the way you feel about the entire marketplace. Then on the flip side, today, you know, China GDP came out and was absolutely horrifyingly bad for China. Do you even see it in the tape anywhere? Because I sure don't. Okay. One of the points to be made is, again, we're data dependent, but the only data we care about is right here at home. I mean, take a look specifically at FXI, excuse me, Chinese markets. Chinese markets, they're just tanking the last couple of days. The GDP number, you know, crushes, this is FXI is Chinese large caps, crushes the Chinese large caps into the open. But again, do numbers even matter? We rallied right back up with the remainder of the marketplace. So one of the things to be able to discern, the market right now is moving as one unit. It's moving as a whole. Got to be careful then with your allocations. This actually goes right back to what I was talking about, right, in the beginning of this update, in that the entire marketplace is actually trapped inside of another volatility box. And the reason that that is so critically important, all of the stocks are too. So if we were to break the upside of the volatility box and you're bearish, you're done. You break to the downside, you're done if you're bullish. You're going to have to be a little bit constrained with allocation at this point in time. Again, to further some of the issues in the marketplace right now, and I'm talking about a lot of issues. One of the biggest issues that we're facing, okay, inverted yield curve. For this, we're actually going to cruise over to Tasty. Tasty, and specifically the small exchange, does a phenomenal job. They show the 2-year, the 10-year, and the 30-year. That 2-year is presently at 3.124%. But wait, then you actually, and again, let's just clarify that that's the 2-year. Then you jump out to the 10, right? The 10 has actually dropped to 2.919. And then the 30-year, just around 3% over here. We are completely inverted, people. It is hideous because for the most part now, the marketplace and everybody's talking about rising interest rates. You're exactly right. The short end of the curve, the 2-year, okay, the 1 month, the Fed fund futures, they're flying up. But when you start to look at stuff like the 10-year, and again, I want to show you what the 10-year looks like. Let's actually bring up TNX, okay? Look at the 10-year this week. Does that look like it's ripping to the upside? Absolutely not. I mean, what has the 10-year done on the week? It's actually down. So higher interest rates, but lower interest rates in like the 10-year. So we're pricing in right now a recession. But the craziest thing is we're pricing in a recession with rampant inflation. And I'm also going to further it with, again, I'm talking about, economic issues. Obviously, the inversion of the yield curve is a critical one, but the dollar, the dollar against commodities, this is actually crisis level at this point. And there's an area that a lot of people don't necessarily think about, and that is here in the US, all right? And not everybody that tunes into this lives in the US, but specifically here in the US, most Americans don't think too much about the fact that everything's priced in dollars and our prices are going up and our gasoline's more expensive. But can you imagine, okay, and I'll start with something significant in size. If you're in Europe, so if you're in Europe, the euro is being devalued substantially, but you're still usually paying for things like oil and American dollars, right? And US dollar, that's it. There's probably not a lot of love right now for the US dollar around the world, or the fact that most of the commodities are actually priced in US dollars. Again, it's not exactly a popular topic around most parts of the world. Again, I've been discussing this a little bit. At what point are we just going to throw in the towel and admit where there's a pretty serious crisis going on here? Everything from the British pound. Again, you could have been alive a very long time and not had seen the British pound at these particular levels. And again, there's a brief and fleeting moment relating to Brexit in here. Nevertheless, you can go back and pretty much in the history, all right, that we have all the way back, you will not see the British pound at lower levels. If we actually bring up the yen, it's the exact same thing. We don't even have historical charts back any beyond 2003, at least here on thinkorswim, that show the yen this. And again, you're paying for most of your commodities in in US dollars terms. It is something that is going to weigh on global growth substantially. It actually explains one of the reasons where Chinese GDP, everybody's talking about lockdowns and so forth. They're getting annihilated over there because most of the commodities are still in US dollars. So it's not a lovely picture that I have painted. Nevertheless, we're on a bounce. And the last several times that we've actually bid up, we've come right into this 39.31, okay? For right now, okay, just for the time being, I'll put a target on it, okay? I would like to actually see us check this box. And it's not that wild, one more up day and there we are, 39.31, and kind of check that box before we could actually even consider any more downside. But then again, we're data dependent. Like, you've got to realize how sketchy we are day to day. One thing I've been reiterating kind of week in and week out: stop trying to handicap every single move. Try to handicap risk reward. Okay. The risk reward hasn't changed, in my opinion. There is absolutely upside potential. In fact, getting above this 39, 31, we'd rip. Like, we can have some legs to us, even come back close to this 4,000. But the downside risks remain, and you can taste them, you can touch them, you can see it in some of the sell-offs. Last thing I want to mention regarding the SPX, one aspect that really resonates with me, and this is on a very, very negative front, and that's this. Okay. Look at the move today. So today we have a 72-point move, right? Great. 72 points higher or lower, it doesn't matter. You do realize the entire week we were looking for a $94 expected move. So if you're selling shorter duration options, you get a 70-point move down one day, a 70-point move up the next day. Does that make you feel warm and fuzzy about selling options on a $94 expected move? Absolutely not. Do not sell anything in the shorter duration, or you're going to get killed. This coming week, we are plus or minus, okay? We'll just round it to roughly 89 bucks. Not too different than the week before, down very, very slightly. But I continue to reiterate, any data is going to cause this marketplace to rock, okay? With an $89 expected move, any announcement hits the tape that's unforeseen, we're going to explode higher or lower. Don't trust the expected move, or if you will, us to stay inside of the expected move. And that is a huge statement. What we're doing right now is we went from this period, and I was talking about this just a few weeks back, but we went from this period of incredible inefficiency, broke the expected move, broke it, broke it, broke it. I mean, we're talking huge, vicious breaches of expected move. And then we kind of consolidate, we consolidate, and we consolidate. But right now, we're dangerous because the actual moves that are occurring, what we term historical or realized volatility is actual price movement. Actual price movement, week to week, is outpacing implied, okay, movement. Meaning that, so you're looking for this, $88 or $89 expected move. And again, the expected move, I'm kind of zeroing in over here at about 87. Just so you guys know, it does fluctuate ever so slightly. So it is critical to know that it's back up to like 88, 89. Okay, that number is based on the options marketplace. It's rare that I ever say this, but the option marketplace is doing a horrible job of handicapping risk on a week-to-week basis. The actual moves that are occurring are much larger than the option markets are giving them credit for. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.